Hi, it's Mike Ryan again. One question I get often is how do I get started in finding money to start my venture? And it's a great question. It's one area that everyone has always some different way of approaching it. I think just to give you an overview, there's really a few different stages that happen typically with inside a startup. And usually, when you start a venture, you start a new company, an individual will typically tap into their own savings or that of, as they call them, friends, family, and sometimes fools that you have that believe in you and believe in the passion that you have in starting a company. And that's usually the best place to start. And if you don't have savings, then I think the number one funding source for a number of companies, at least in the late 1990s and 2000, was the Bank of American Express or credit cards. And you hear stories that are legendary of people who finance their companies based on credit cards. And so that's definitely a way of debt financing. Ideally, before you make that leap into start your company, it's always good to have a cushion, depending on the size and scope of the organization. But even if it's yourself for income replacement, to have 6 months to a year, if not 2 years or more, that you can survive with very limited or minimum inflow of income. And so have that working capital is, as they call it, bootstrapping, that comes from your own resources that you built up. And so that's really the first stage is the bootstrapper. The other is creating revenue by selling products or services. And if you get to, depending on the type of service or product you have, you may actually tap into partnerships with clients to help develop something and to bring revenue in while you're waiting to, test the concept or test your product if it happens to be in some areas like software or some other type of company that depends on having a developmental phase as opposed to a product or service that is ready and ready to hit the market to be sold and to generate income. The other phases that typically come are within the angel round, and that usually is at a later stage, not always, but would typically be after a company's established itself, hopefully has some type of revenue, has a product to sell. You go out into the market and through your greater network of friends and family and individuals that are called angels. And an angel or a super angel is someone who has the ability to write a check, and whether that is $25,000 or that's $500,000 or whatever. Super angels tend to be in the over 100,000 to a million range. Would be typically high net worth or individuals that were entrepreneurs that have been successful and want to take a risk in investing in another company or individuals. And as I say to entrepreneurs all the time, people rarely invest in companies. What they invest in are people, and taking a calculated risk that you think that this individual who has this idea or this concept or a product or solution has the ability to capture a market, a larger market opportunity, to do something different, to be innovative, and that you as an angel investor are going to invest in that individual, so they have a return on investment that happens anywhere from 3 to 5 years out. The next stage is really what's called a Series A, as an A, B, and C, D rounds. That typically the angel round can be anywhere depending on what the needs are, the mix between the revenue that's generated by the company and what the working capital needs are and the size and scope of the organization. Really would be usually under $1 million. And then the next level is when the Series A, which is more of a, it could be as low as a few $1,000,000, but typically is in the $3 million range is what most venture capitalists look at as far as investing. They have been known of recent with the market downturn in 2008 and others, they've been known to go down to lower funding levels. But typically they want the venture capital or VCs typically want a company that has proven itself, unlike the .com era, has proven itself as a world-class team that has a product that is in the market, that's created some type of revenue, and that has a pathway to profitability, and that ultimately can have a return on investment for the venture capitalists when they are looking to exit, have some type of liquidity event, or selling the company, or taking the company on a public offering, which is very rare these days. It's been accelerated this past year, 2010. But in 2008, 2009, there was less than a handful of companies that actually went public. And that's changing, but that's where they get their exit strategy, through either a IPO, initial public offering, or a merger or sellout to a larger company. So that's a little bit on the finance of when you get your company, how you want to get your company started, where the funding comes. It really comes from yourself, then it comes maybe from angels, and then either venture capitalists or strategic partners as you grow and need additional money to grow and to have the company scale to a larger degree. So that's it. Bye.